Tom Kendall, head of precious metals research for Credit Suisse, joins us today on the line, and we'll be getting his forecast for gold and silver in 2014. Tom, thanks for being with us.
Sure, not a problem.
So, Tom, as we're wrapping up 2013 here, I know Credit Suisse had put out a forecast for gold for $1,180 in 2014 and $1,200 gold in 2015. Are these numbers that you're sticking to?
Yes, sure. Those are still our current forecast. Our annual average for next year is 1180. We're looking for gold to average 1150 in Q3 and Q4 next year. So we're still bearish from current levels.
So why are you bearish, Tom?
Well, we're bearish because when we look at the factors that drove gold up and pulled in so much investment money to gold, we see those factors have greatly diminished already, and we expect them to diminish going forwards. In particular, when we look at the U.S. economy, 2013 was a better year than 2012, and 2014 will be a better year than this year, barring anything very unexpected on the macroeconomic front.
So, Tom, are you predominantly basing this on a recovery in the U.S.? And what about quantitative easing, which now seems clear Janet Yellen will continue in 2014?
Well, we're not basing our view solely on what happens with the U.S. economy. Let's be clear about that. Wherever you look, whether it is at systemic risk in Europe or the fear of inflation globally, or what is happening with U.S. monetary policy, we think the direction of travel is a lot more positive than it was, and so that tends to be bearish for gold. There is really no developing world inflationary pressure to speak of at present. There are still, of course, substantial structural problems in Europe that have to be dealt with, but the risk of a systemic collapse in the financial system has greatly diminished. And as I say, the US, yes, we are still in a world of very unorthodox and easy monetary policy, but we are very slowly heading in the direction of normalization of that policy.
Tom, you mentioned inflation, which could be a looming threat to the U.S. What could that mean for the metals?
Well, it's all about really expectations of future inflation when we think about gold. It's not so much about what inflation is doing today. It's really about how the market and investors perceive inflation in 12 months, 24 months' time. And 3 or 4 years ago, as the world embarked on this period of excessively easy monetary policy, as some would say, to defend against the risk of deflation and stagflation, a widespread concern amongst investors was that this printing of money would lead to an uncontrolled breakout of inflation, but it hasn't come to pass. We don't think it will come to pass. We think we will need to see a lot faster credit demand in the developed world. We will need to see a lot of the spare capacity that still exists in developed economies taken up before we can even think about inflation becoming a concern. And that's going to take some considerable time in our view.
So, Tom, as we all know, forecasts do change, and we've often seen banks revise their forecasts throughout the year. In your opinion, what would be needed in order for you to revise your forecast and have more of a bullish stance for gold?
That's a good question. It would, I think, in broad terms, need the global economy to go back to quite a bad place. We would need to see fear coming back to the fore amongst investors, whether that be fear that Europe is unable to get through the debt restructuring that still needs to happen, or whether it be fear that a Federal Reserve led by Janet Yellen will be too easy with respect to monetary policy and will keep things flowing in terms of liquidity around the system for too long. Or some, really left field tail risk comes to the fore, which is always possible but unforecastable. We don't think, as I say, inflation is a concern, certainly not for the next 12 months at the very least. We think a Janet Yellen-led Fed is unlikely to deviate too much from the policy instigated by Bernanke I think the changes are likely to be in terms of communication rather than what they do or do not do in terms of tapering. And so, yes, it's as you say, it's always possible that events change and that we would have to go and revisit our forecast. But right here, right now, we think that's unlikely.
And does your bearish sentiment spill over into the other metals, or are you more bullish when looking at silver, platinum, or palladium?
Yes, relatively speaking, we are a little bit more, I hesitate to say bullish, but positively disposed would be a better way of putting it towards silver. It's been impressive the way that physical investment demand, whether it be in the form of ETFs, coins, or small bars, has held up very, very well in silver. I think the argument that it should do better than gold as global economic output improves probably does hold true. And we are looking for a reasonable acceleration in global growth next year. So in that environment, I think silver can hold up relative to gold. When we look at the platinum group metals, clearly there's a more fundamentally driven story there of supply versus demand, and we're positive on both of those metals, but think it may take some time for market stocks to be absorbed to the point at which both those two metals genuinely begin to tighten.
Okay, Tom, and with the few minutes we have left, do you have a trading range that you're looking at for silver in 2014?
I haven't published a range, but our forecasts are published and out there. We are looking for silver to continue trading in the low 20s, and so not too far from where we see the metal sitting today.
Excellent. On that note, thanks so much for your time today, Tom.
It's a pleasure. Thanks.
And thanks for watching this edition of On the Spot with Kitco News. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboni. Thanks for watching.